$1.2 billion disappeared with Webvan. Not in one dramatic market crash, but in the quiet paperwork of a July 2001 SEC filing. Thousands of jobs vanished. A logistics network built for the future of retail became nearly worthless. The post-mortem would blame the dot-com bust. The truth is more forensic. Online groceries as an idea was sound. The model behind Webvan was not. Every order, packed in a billion-dollar warehouse and delivered in a custom refrigerated van, cost more to fulfill than the customer paid. Growth did not lead to profitability. It poured fuel on the collapse. But 2 years earlier, Webvan looked nothing like a corporate cadaver. It was one of the most anticipated IPOs of the dot-com boom. A Wall Street darling backed by the most respected names in finance. How did a company with that much capital and a seemingly brilliant idea drive itself straight into bankruptcy? The pitch was flawless because the problem was universal. Every week, millions of Americans spent hours navigating crowded aisles, waiting in checkout lines, and hauling heavy bags. Webvan offered a simple, elegant solution: groceries delivered. The idea was developed by Louis Borders, a founder with a proven track record through his activities at MIT and in Boston, and it immediately attracted the most respected names in finance. Investment banks like Goldman Sachs and venture capital firms like Sequoia Capital saw not just a company, but the future of retail. They were betting on a visionary and a market believed to be worth hundreds of billions. This was the era of get big fast. The core doctrine was to achieve market dominance, even at the expense of sustainability. Investors poured capital into Webvan with the explicit goal of an aggressive, nationwide land grab. With early funding rounds securing over $300 million, the company had a mandate to build first and ask questions later. Profitability was a distant concern. The only metric that mattered was speed. The goal was to dominate online grocery delivery before anyone else could even draw up a plan. The vision was perfect. The backing was unparalleled. But to connect the two, Webvan would have to build a logistics machine the world had never seen. And every gear in that machine would be forged from cash. Flush with capital from its public offering, Webvan embarked on a strategy of breathtaking scale. Its market valuation soared during the dot-com bubble, a fevered number that would ultimately crumble into bankruptcy and over $830 million in losses. This was not growth. It was a declaration of war on the entire retail sector, fueled by dot-com exuberance. The market rewarded this audacity, believing that achieving national scale was the only moat that mattered. The ambition was clear: expand into every major American city and do it yesterday. The balance sheet, for a fleeting moment, looked like a blank check with a value approaching $10 billion. The spending was colossal. The plan required a network of highly automated distribution centers, each a technological marvel, costing tens of millions. The total capital expenditure for this logistics network was projected to exceed $1 billion. With this war chest, the company began expanding into new cities, including Chicago and Atlanta. Yet the core model had never been proven profitable, not even in its initial San Francisco market. Each new city was not a validation, but a multiplication of the same fundamental gamble. Financial filings reveal the consequence: a staggering cash burn rate that consumed capital at a pace that even its massive funding could not sustain. With its infrastructure humming, the company seemed unstoppable. But inside the operational data, a fatal flaw was hiding in plain sight on every single delivery run. The core of Webvan's failure wasn't strategy, it was arithmetic. The company had mastered the warehouse, but it could not solve the last mile. That final, ruinously expensive journey to a customer's door. The cost was staggering. Pick an order, pack a tote, dispatch a custom refrigerated van to a low-density suburb. The operational expense per delivery was immense. Against this, the revenue from an average grocery basket was a pittance. The equation never balanced. Every single delivery was a net loss. This wasn't a temporary loss leader strategy. It was a permanent structural deficit baked into the model. Growth did not create efficiency. It amplified the burn. More customers meant more money-losing transactions, digging the financial hole deeper with every van dispatched. This is a classic symptom of a broken model. The belief that scale can magically fix negative unit economics. It cannot. For Webvan, each new customer was a liability. Each new city was a new center for burning capital. The entire enterprise was built on an unsolvable equation, an equation concealed only by the market's irrational exuberance. But as the new millennium turned, the dot-com bubble began to hiss. The very funding that masked this fatal flaw was about to be turned off. And when that tap ran dry, there would be nothing left to stop the hemorrhage. When the dot-com bubble finally burst, the flow of capital that sustained Webvan's impossible economics was severed. The company, built for perpetual motion, ground to a halt. The final phase was not a slow decline, but a rapid, cascading failure. Beginning in early 2001, management began a desperate triage, shutting down operations in major markets like Atlanta and Dallas. Each closure was an attempt to staunch the bleeding, but the wounds were fatal. The billion-dollar network of automated warehouses, once the engine of expansion, now represented an anchor of insurmountable fixed costs. On public markets, the judgment was swift and absolute. The stock, once celebrated as the future of retail, collapsed into worthlessness. Its price plummeted from its post-IPO peak, eventually trading for mere pennies before the final indignity of being delisted from the Nasdaq. In July 2001, the company filed for Chapter 11 bankruptcy protection, officially admitting defeat. The last of its cash reserves were gone. The mass layoffs began, terminating the jobs of thousands of employees. The sophisticated infrastructure, the custom fleet, the very assets that were supposed to build a $10 billion enterprise were liquidated for cents on the dollar. The warehouses were shuttered. The vans were sold. But was Webvan simply a company ahead of its time? Or was its failure a foundational lesson that today's billion-dollar delivery giants are still trying to learn? Webvan's central failure was not a lack of vision. It was a textbook case of premature scaling. The company built a national infrastructure for a model never proven profitable on a single block. It mistook capital for validation, building the factory before designing a sellable product. This is the ghost in the machine, the flawed assumption that scale can fix a broken financial equation. Decades later, the grocery delivery landscape is crowded with players attempting the same last-mile puzzle. Their models, however, are a direct reaction to Webvan's ruin. Many avoid billion-dollar automated warehouses, opting for asset-light strategies. They leverage existing stores as fulfillment centers and use gig drivers, shifting the capital burden. Others pivot to omni-channel, blending online orders with in-store pickup, sidestepping the immense cost of home delivery. The $1.2 billion erased by Webvan wasn't just a loss. It was the tuition for an entire industry. It remains a permanent lesson on the primacy of sustainable economics over growth at all costs. The brutal trade-off between convenience and cost, what the company fatally ignored, is still the central challenge for the on-demand economy. Its ghost still haunts every startup promising instant delivery. It asks a simple, brutal question. Have you actually solved the last mile? Or are you just using investor capital to subsidize a problem that remains unsolved?